Welcome to the Slop Farm. Enjoy the video.
Start by pulling the period financials and legal constraints. You need the trial balance, income statement, and balance sheet now. Reconcile accounts that affect distributable profit and flag non-cash items like depreciation and unrealized gains. Once done, adjust for tax provisions and any prior year corrections so the base profit reflects reality. Make sure to note statutes or bylaws that limit distributions. These rules change the pool available for distribution and prevent later reversals. Now perform the adjustment step by step. Deduct non-distributable items such as capital contributions and unrealized gains because they cannot fund dividends. Then add back allowable non-cash charges like depreciation and certain provisions since they reduced accounting profit but not cash available. Next, allocate mandatory reserves and set aside amounts required by law or your articles. This reduces the distributable pool but protects creditors. Once allocated, compute the net amount left that can be divided among stakeholders. Finish by calculating net divisible profit. Take the adjusted profit, subtract mandatory reserves, current tax payable, and any approved retained amounts. Then apply your distribution policy. Respect share classes, ratios, and maximums so allocations are precise. Before paying, confirm available cash or liquid assets to avoid insolvency. If cash is insufficient, defer or use approved borrowing. Finally, document the board resolution, secure required approvals, and record the transaction so the division is auditable and legally compliant. One tip: recheck tax estimates to avoid surprises.
Thanks for watching. Consider subscribing if we helped you today.